1 year from now, we will see a retreat. Why? Well, there are just excessively numerous occasions unfurling this year that will set the phase for a retreat, including a corporate income subsidence, the development hindering Brexit vote, and a U.S. presidential decision dissimilar to any we have ever experienced. Gold buyers are falling asleep at the wheel. It is late July. Beach vacations are calling. The recent upside breakout lost its momentum. Why should you be looking at gold now? The U.S. economy could be on the verge of recession next year. In that scenario, this year's gold price levels will look cheap. Any one of these events could be the direct catalyst for next year's recession, or it could be one of the many other reasons not listed. While I can't predict the exact catalyst for the event, I do know that I'm not the only one expecting the worst. In fact, according to a recent report, companies are preparing for a recession as well, and you should be doing the same. In the latest durable goods advance estimate for June, orders tumbled 4% versus expectations of a 1.7% decline. Durable goods orders represent orders for products that last typically for at least 3 years, like appliances, office equipment, motor vehicles and turbines. Earlier this month, I explained how declining durable goods orders mean that the Federal Reserve's hands are tied, and that interest rates are not going higher by any meaningful degree for at least another decade. This remains true, but you also have to be prepared for the inevitable, the recession. 3 reasons the U.S. economy is vulnerable. The International Monetary Fund (IMF) is worried. Just this week, the IMF issued an urgent call to group of 20 largest economy nations to implement more policies to encourage economic growth. The IMF reportedly said that global central banks should keep their easy money monetary policies and that the G20 should develop contingency plans in case the sluggish global performance shifts into a recession. 2017 is the first year in the U.S. presidential election cycle. No matter who wins the current nail-biter of a race for the White House, the economy and stock market will become vulnerable in 2017. The 4-year presidential cycle is well documented. It is in the early years, usually first 2 years of a new administration, that wars, recessions and bear markets usually begin, says the Stock Traders Almanac. The reasons are simple. The new president usually slides into the White House boosted by a strong mandate and support. The new president will move to enact their various programs and agendas, often which are not necessarily supportive to the economy. Additionally, whichever candidate wins, business uncertainty will remain high, which will weigh on new business spending, investment and hiring. Businesses will hunker down and wait to see how and where the dust settles before putting into place new or aggressive expansion or building plans. Bottom line, that means less spending, less hiring. The current U.S. expansion is old and running on fumes. The National Bureau of Economic Research, the arbiter of when recessions start and end in the U.S., declared that the Great Recession ended in June 2009. The U.S. economy is currently in its 85th month of expansion phase. And all economists admit the current expansion is half-speed at best and never saw the U.S. economy charging on all cylinders. The current expansion has been fueled by aggressive Federal Reserve easing tactics. But, yet the U.S. economy never even got back to so-called trend growth in the 3.5% level on a sustained basis. Falling corporate confidence. I follow durable goods because it tracks corporate spending on items that can be considered an investment. In other words, it represents corporate investment outside of mergers and acquisitions, employees and other big-ticket spending. Essentially, durable goods orders tell us how confident companies are in growing their business. Rising durable goods orders show confidence the economy will continue growing, while falling orders signal a shrinking economy and curtailed spending. During the past 2 decades, durable goods spending has only slowed from steady increases on two occasions. The first was a precursor to the 2000 to 2001 recession. The second was in the midst of the 2008 global financial crisis. Today, we are seeing the same thing happen again. The latest durable goods report shows that companies still have no confidence in the economy and are not increasing investments in this environment. You can see that from 1992 to 2000, roughly 8 years, durable goods orders rose at a choppy but steady path. From 2001 to 2008, roughly 7 years, we see the same thing, choppy but steady growth. And from 2009 to 2016, about 7 years, we saw similar results. There's a pattern here, and each time durable goods orders slow or turn lower, it signals an imminent recession. Today is no different. Be prepared for the recession. Your takeaway here is simple. Prepare for a recession-like investment environment. That means you want to own safe haven stocks. Think gold-related stocks, utilities or telecommunication companies, bonds and even some blue-chip stocks. But the main thing you want to consider, if you haven't already, is to find a strategy for profiting from declining stocks. Depending on how you manage your money, this can be easy to do. If you are managing your own portfolio, a long-term put option on the Speedy RSM page 500 ETF NYSE SPY expiration in 2018 would be ideal is a simple way to profit from a recession and decline in stocks. If, instead, you have an advisor who manages your portfolio, tell them you want more bearish exposure, assuming you have little at the moment. It's your money, and they will listen and help you prepare for the imminent recession. They should be able to put your investment in some simple bear funds that benefit from a market fall, or they might also consider buying an inverse ETF that returns the opposite of the underlying equity. Just keep in mind that these positions are used as protection to hedge your portfolio from a crash. The further we get into 2017 without the expected stock market crash, tilt your portfolio more and more to positions that will rise when the crash hits. The average length of a U.S. expansion cycle through is 69.5 months, according to the North by Easter. That means this current expansion cycle is already on its last legs. Key takeaways. When you put together the struggles in the larger global economy, Brexit uncertainty, still sluggish growth in Japan, slowing growth in China combined with the fact that a new U.S. president will take control of the helm in 2017 with all the uncertainty that will bring no matter who wins and the fact that the current expansion is old, the odds of recession appear to be climbing. What this means for gold. According to data from the Stock Traders Almanac, most bear markets in stocks occur in the first or second years after the presidential election. When stocks suffer, investors historically turn to gold as a safe haven, an alternative asset and a wealth-building tool. If the U.S. economy slides into recession, the Federal Reserve will be forced to resort to even more creative and off-the-books monetary policy engagement. WHICH will be gold supportive. Investor to-do list. Long-term gold buyers have been supporting the yellow metal all year on corrective pullbacks. Gold is a little sluggish right now. The summer doldrums are starting to kick in. Use this time to pick your next buy spot. If history continues, the buying opportunity won't last long. The UK is likely to enter a mild recession by early 2017, following its vote to leave the European Union (EU), Goldman Sachs economist wrote in a report released Sunday. The bank's economist walkout lost its momentum. Why should you be looking at gold now? The U.S. economy could be on the verge of recession next year. In that scenario, this year's gold price levels will look cheap. Any one of these events could be the direct catalyst for next year's recession, or it could be one year from now. We will see a retreat. Why? Well, there are just excessively numerous occasions unfurling this year that will set the phase. For a retreat, including a corporate income subsidence, the development hindering Brexit vote and a U.S. presidential decision dissimilar to any we have ever experienced. Gold buyers are falling asleep at the wheel. It is late July. Beach vacations are calling. The recent upside break one of the many other reasons not listed. While I can't predict the exact catalyst for the event, I do know that I'm not the only one expecting the worst. In fact, according to a recent report, companies are preparing for a recession as well, and you should be doing the same. In the